Let's do a quick check-in. So far, we've talked about the different categories and types of financial institutions, from universal banks that do virtually everything through to building societies and savings and loans associations that are much more limited in scope and reach. We also talked through all the different types of banking services and the profiles of different clients that would use these services. Now it's time to explain just how it is that a financial institution makes money. We'll walk through what a bank's balance sheet and income statement look like, as these statements look very different compared to a traditional company. We'll also discuss how the returns are measured by a bank, including the ratios that are important to them, and how they go about mitigating and minimizing financial risks. We'll complete the course by walking through the various careers that you can pursue within a financial institution. This is your opportunity to think about what you believe your strengths to be and what calls your attention. Do you think you might be interested in investment banking, or does a career in commercial banking seem better suited for you? Let's get back to the course. Now that we've looked at the different categories and types of banks and the products and services they offer, let's step back and look at the bigger picture that's applicable to virtually all financial institutions. How do they make money? In this session, we'll walk through what a balance sheet of a bank looks like, what makes up its revenues and expenses on its income statement, and how returns are measured. To understand a bank's balance sheet, let's first look at a typical non-bank's balance sheet. On the left, we have the categories that make up an organization's balance sheet. We have assets, made up of current assets such as cash, accounts receivable, and inventory, and non-current assets such as property, plant, and equipment, long-term investments, goodwill, and intangible assets such as patents and trademarks. On the other side are the liabilities and equity that fund the company. Current liabilities will include accounts payable, part of the working capital of an organization, as well as the current portion of long-term debt. Non-current liabilities include long-term debt, and equity includes share capital and retained earnings. Working capital, interest-bearing liabilities, the loans the business has, and equity are what make up the sources of funding for the business. On the right, we have the categories that make up a typical bank's balance sheet. The assets in a bank are different to that of a normal business. Starting with the assets, you can see the differences instantly. For a bank, the main assets include loans that are made to clients. These loans will be both current and non-current. Trading assets are those that are held for trading purposes, where the bank must maintain a certain amount of reserve and therefore can't use the assets to make loans. These include cash, brokerage receivables, loans and advances to other banks, debt securities, and equity instruments, to name a few. And other assets include property, plant, and equipment, goodwill, and intangibles. On the other side of the balance sheet is where the funding of the bank is. The funding of a bank includes client deposits, which will be short-term, such as from current accounts, and long-term, such as from term deposits. Trading liabilities contain those same financial instruments as those on the balance sheet, but reflect financial instruments owed in trading activities versus the assets which are owned. Debt relates to borrowing that the bank has to fund its assets, and equity is the other funding source, made up of share capital and retained earnings. A typical bank classifies its financial assets and liabilities into the following categories: loans and advances made to clients, financial assets and liabilities at fair value through profit and loss, financial assets and liabilities held for trading, available for sale, and other financial liabilities, and financial assets that are held to maturity, and financial liabilities that are held at amortized cost. The value of the financial assets and liabilities change during the year. If the fair value of financial assets has increased or the fair value of financial liabilities has fallen, this will represent a gain during the year which is shown in a typical bank's income statement. If the fair value of financial assets has fallen in the year, or the fair value of financial liabilities has increased, this will represent a loss in fair value, which is also shown as a loss in a typical bank's income statement. Moving to the income statement, we can again see that this statement differs from most companies. First, a bank's main source of revenue comes from interest income and other service-related fees. Net interest income is often reported first and represents the difference between the total interest earned and the total interest expense. A bank will typically show interest income less interest expense to reflect net interest income versus showing interest expense lower on the statement. That's because interest expense for a bank is much like cost of goods sold or cost of sales for a typical company. Interest expense is what a bank pays to earn the income. Non-interest revenue shows next. These relate to service fees such as application and account maintenance fees and commissions. Provisions for credit losses relate to actual and anticipated losses on loans where the client is likely to default. A component of the provision may also be calculated based on what the bank's regulator requires. We then have the net gains and losses that arise from the movement in fair value of financial assets and liabilities at the balance sheet date, as noted previously. Next are the non-interest expenses. These will include all the operating expenses the bank has, such as payroll, general, and administrative expenses. And that leaves us with income before tax, the calculated tax provision, and finally, net income. As mentioned, the net interest income is the difference between what the bank earns from interest on its client advances and loans, trading assets, and the like, and the interest it pays on its customer deposits and trading liabilities and long and short-term debt. The net interest income is a key metric used in the banking industry and is closely monitored both internally and externally. Let's consider the following example. Based on the information given, what do you calculate the net interest income of this bank to be, based on its balance sheet? The first step is to calculate what the interest income is from the asset side and what the interest expense is from the liabilities and equity side. Thus, we arrive at a net interest income amount of $53 million. Let's dig into the other components that make up a bank's revenue in a little more detail. Here we have the normal components of revenue at a universal bank. We've already covered net interest income, but let's have a look at the other non-interest revenue accounts. As you can see, a bank can earn a lot of revenue from the commissions it charges for various services and also for a variety of different fees. Fees are often charged for loan applications and for account maintenance. There are broker fees paid when dealing with asset management, and investment banking will bring in high fees for its advisory services relevant to underwriting and its sales and trading activities. The commercial banking and corporate banking activities also bring in high advisory service fees, along with the loan application and account maintenance fees mentioned previously. Where the bank has its trading book of financial assets and liabilities through its treasury management services, it can also earn profits on the sale of investments. And finally, there can be other customer service fees that will be transaction-related. They could be fees such as for ATM usage, for purchasing physical checks for use, or fees for insufficient funds or for account closures. Let's direct our attention now to how a bank measures its returns. This ratio tree represents the key levers bank executives can use to monitor and improve the performance of the bank. The main goal of the bank, as it is for most businesses, is to maximize, or at least optimize, return to shareholders. The metric, return on equity, or ROE, is calculated by dividing shareholder profit after tax, into the shareholder's investment in the bank, the equity. The return on equity can be further subdivided into a return on assets ratio and a leverage ratio. This shows whether ROE is being impacted more by profitability or by the bank carrying more or less debt on its balance sheet. Sometimes a bank will borrow more in order to increase or at least stabilize ROE, and it's therefore very important that this ratio is monitored. If a bank becomes too highly levered, it can be at risk. If there was a sudden market downturn, that could impact the bank's ability to repay its debt. Here, we can compare two banks, one with relatively low levels of debt, low leverage, and one with relatively high levels of debt, high leverage. In the low leverage bank, the assets are generating a return of 5% multiplied by 1,000, but are paying interest on debt of 3% multiplied by 800. This results in a profit after tax of 26, which is the 50 less the 24, and a return on assets of 2.6%, the 26 divided by 1,000. The leverage ratio for this bank is 5, the total assets of 1,000 divided by the total equity of 200. Combining the rate and leverage ratio generates an ROE of 13%. Now let's look at the high leverage bank. In the high leverage bank, the only difference is the level of debt. Note how, by leveraging the bank's balance sheet, the ROE is considerably higher at 23%. And so, you can see that leverage has an exponential impact on a bank's ROE. In the recent past, the banking industry has been operating at high levels of leverage. This has led to increased risk, which has been and continues to be addressed by international regulators, as it led to a financial crisis not that long ago. Moving back to profitability, let's have a look at the operating efficiency ratio. This ratio shows a bank's efficiency by comparing non-interest expenses such as salaries, occupancy costs, technology expenses, and other administrative expenses to net interest income and other income. Assuming our base currency is the dollar, the operating efficiency ratio will tell us how much it costs for each dollar earned. For example, an efficiency ratio of 85% means that it costs 85 cents to earn $1, leaving only 25 cents as profit. Therefore, the lower the ratio, the better. Most financial institutions aim for a ratio between 70 to 80%. Leading-edge financial institutions are able to deliver operating efficiency ratios as low as 60%. Based on the information given, calculate the bank's net profit before tax. Also, calculate the operating efficiency ratio. What does this tell you about the profitability of this bank? This is a universal bank, and so the numbers are quite high. The net profit before tax comes to $2.5 billion. But what we really want to know is, how efficient was the bank in earning this profit? As we can see, the operating efficiency ratio is 66.7%. We saw previously that most banks are in the 70 to 80% range, and so we can conclude that this bank is operating fairly efficiently and better than most of its competitors. Asset liability matching is also an important concept in the banking industry. It's the practice of investing, buying, liquidating and allocating one's assets in the need of covering its liabilities. Treasury managers need to carefully manage assets in a portfolio and ensure there's enough liquidity to cover any cash needs. Proper asset liability management, known as ALM, helps minimize financial risks that could result from mismatches between assets and liabilities in an investment strategy. Particularly, asset liability matching focuses on reducing interest rate risk and liquidity risk, as these are the most common risks impacting a bank's balance sheet. ALM makes sure that the bank is able to meet its medium and long-term financing needs. It also minimizes the risks of losses due to movement in the capital markets and in interest rates, and could therefore impact the bank's cash flows. The management of interest rate risk can be done by matching the maturities and interest rates of loans with that of customer deposits and other investments. Securitization is also a risk management tool used to reduce idiosyncratic risk associated with the default of individual assets. Banks and other financial institutions use securitization to lower their exposure to risk and to reduce the size of their overall balance sheet. The securitization process is broken down into two steps. First, the bank combines multiple assets into a single compound asset. The return offered by the compound asset will be a weighted average of the return offered by the individual assets it's comprised on. These assets are often debt instruments such as mortgages, loans, credit card debts, and also leases. Next, the bank sells the compound asset to third-party investors as securities, which could be in the form of bonds or collateralized debt obligations, otherwise known as CDOs. A common securitized product is a mortgage-backed security, an MBS. An MBS can be packaged as residential or commercial mortgages, or they could also be packaged based on the credit risk of the mortgages bundled into what's known as a tranche. What the bank will do is they'll typically sell MBSs in tranches to institutional investors. The bank will use the proceeds from the sale to mitigate its own risks and often to make new loans.